welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Ananth Narayan, Professor of Finance, SPGMIR, joining in. Ananth, welcome to the show, and always a pleasure to get insights from you and to understand a lot about the economy. Ananth, my first question coming to you. Let's start with Omicron. With Omicron again, overall, if you see in terms of the economy, the way it has been progressing so far, do you think that is something that everyone needs to consider from here on from an economy perspective?
Well, first of all, thank you for having me, Hiral, and it's always a pleasure to be on your show. Look, Omicron, we don't know enough as yet. We are getting more and more data as we speak, and I'm sure we'll be wiser the next week and the week after. As things stand, it seems to be extremely infectious, but not necessarily debilitating in terms of the extent of the disease. So hopefully it plays out that way and isn't a repeat of the Delta variant really. But to your broader question on the impact on the economy, clearly on the health side, we've got to be very, very careful. There is complacency on the street, and I hope that settles down pretty fast. We can't afford another health crisis, and we don't want another health crisis. On the economy, if you look at it, Hiral, while the second wave was really bad in terms of the health impact, the impact on the economy was not that bad, right? Actually, this fiscal year, first half so far, including the months of April, May, and June, which were impacted by the second wave, is holding up reasonably well, even compared to pre-COVID times. The point is that the world and India have learned, as far as the economy is concerned, to live with the virus. From the first wave to the second wave. So the question of, I think a full-time lockdown like we saw in the first wave doesn't exist. You'll probably see localized, control of the disease rather than a full-fledged lockdown. Of course, contact-based services like hospitality, tourism, etc., will be impacted. Restaurants, etc., will be impacted, but it will be limited, and hopefully it will be short-lived. So I don't think this should by itself have a big impact on the economy. But yes, in terms of sentiment, in terms of the animal spirits, in terms of the consumption patterns, it will be delayed. So you might see 3 to 6 months of delay in terms of a full recovery in the economy. Not welcome at all. The economy has taken a lot of hit during the crisis, both globally and locally. But I don't really expect to see a big impact as far as the economy is concerned, besides a phase shift of maybe 3 to 6 months in the recovery patterns.
Right. And with the vaccination picking up, the anticipation is that 90% of India will be vaccinated, at least with the first dose by the end of December. Those are the numbers that we've been picking up so far. And probably at least 40 to 50% on the second dose. How well does that vote for a country like us? Because taking the population into consideration as well, I think we've done a fabulous job. Is that something which we need to consider as well from the economy perspective?
Absolutely, Hiral. So you're absolutely right. I think after the second wave, we've done a remarkable job on vaccinations. In fact, there was a seroprevalence survey done in Delhi a few weeks back, which I think showed about 95% seroprevalence, which means that there is already antibodies anyway, even before the vaccine, and the vaccine obviously has added to that. So in terms of, therefore, our collective resistance to the virus, of course, it's a lot stronger than it was in the second wave. Couple of points though, Hiral. One is we don't know if Omicron is actually going to be resistant to some of the antibodies that have been built to us. So we'll have to wait and see what the data plays out on that. Second is not everybody has been vaccinated. Our children are not vaccinated. Under 18s are not vaccinated. And some of us might start to require boosters very soon. So, that has to be managed as well. But I think the system has understood from the lessons of the first wave and the second wave. You saw the immediate response once the Omicron wave came about, both globally as well as locally. Every authority is standing up and ready with a SOP on what needs to be done if we actually see a relapse of any kind. So I think we will tackle this reasonably well. But of course, this is unwelcome news. There's uncertainty because of Omicron.
Right. And overall, if you see in terms of growth as well, the second quarter of FY22, Ananth, we stood at around 8.4%. And that was marginally better if you see versus the Bloomberg consensus estimates of around 8.3%. Now, taking that into consideration and the focus being on inflation as well, how do you see growth panning out from here on? Because overall, if you go to see, yes, your base is going to be really low to see extensive growth.
No, absolutely. So you're right. The growth has been good. particularly amongst the formal sector and the larger companies, and I'll come to that in a second. Overall growth for this fiscal year, Hiral, should be about 9.5%, which RBI has kind of estimated. It might even be slightly better than that. But even with 9.5% growth, we will be barely above where we were 2 years ago on an overall real GDP perspective. So it's merely coming back to pre-COVID levels, right? By the way, the next year should be good growth levels as well. Remember, the first quarter of this fiscal year, between April and June, was impacted by the second wave. Next year, hopefully, if there is no repeat of any Omicron or any other wave, we should see a correction of that. So next year, again, you could see 8.5 to 9% growth. This is in fiscal year 23, okay, which is again a fantastic growth. But yet, if I compare March 23, if I get a 9% growth compared to, let's say, a March 19, 4 years ago, pre-COVID, it would be annual growth of about 3 to 3.5%, which is nothing, which is very, very small. So we've lost a lot of, momentum along the way. And the full recovery hasn't happened as yet. That's the first point. Second point here is something we've discussed before, which is there is a two-speed economy. There is a top formal part, which is doing remarkably well, very, very well. And there is a bottom informal part, which is unfortunately suffering. The first part, if you see 3,300 odd companies tracked by CMIE, these mostly listed companies, their results for H1 of FY22 show that their earnings have grown by 100% over FY20, which is 2 years ago, pre-COVID. So it's been a remarkable journey for these, and we've not seen this kind of earnings growth for many, many years, since 2005, 2006, such remarkable growth. Likewise, look at GST collections, clearly showing that the formal economy is doing very well. If you see the level of digital payments going through as a percentage of GDP, it's at record levels, 20 to 30%, which tells you that the formal economy is doing really well. Unfortunately, there is also data telling us that the informal economy is doing very, very poorly. Okay, first data point is on employment. Again, CMI data, which is a controversial data, but nevertheless, CMI data tells us that the employment is static at about 40 crore people. Even as of November 2021 end, okay? That actually tells you there's been loss of jobs over the last 5 years to the tune of something like 2.5 to 3 crore in manufacturing and services put together. The terrible statistic. We should be adding jobs, not reducing jobs. Likewise, look at the demand for NREGA, the Rural Employment Guarantee Scheme. It's about 60% higher than it was in pre-COVID times, YTD year to date of November, which tells you that there is pain in the bottom of the pyramid. Likewise, look at micro, small, and medium enterprises. Reports like TransUnion Civil tell you there is pain in that particular part of the economy. So now this part, the informal economy, which is 6.3 crore MSME enterprises, account for about 85% of our workforce, and that seems to be in really poor shape. So you have this two-speed, very, very diverse economy here, where the top 15, 20% is doing remarkably well. And the bottom, particularly the bottom 40%, seems to be in really bad shape, which is not an equitable or a desirable kind of a growth on an overall basis. So there is problems both in overall growth. It's still very, very slow compared to pre-COVID levels. And the quality of the growth is very lopsided, between a formal and informal economy.
Right. So with all of this, how are you looking at inflation from here on as well? Because we did see a cycle of really high commodity prices. Crude as well, again, has started to see a recovery as well after the kind of lows it hit. So taking all of this into consideration, how are you viewing inflation?
Not looking good, unfortunately, Hiral. So we will probably see a rise in inflation going forward. We will see a print for November very soon. That might be about 5.2% or so. Between December and April, inflation could actually average 6% on a headline basis. In fact, for the next fiscal year, FY23, you could see both core as well as headline inflation flirt with that 6% mark. Is that the case? No, there are some good news. One is commodity prices have come back, as you mentioned. There have been tax cuts as well. So, petrol and diesel taxes have been cut down. So that's good news for us as consumers. But unfortunately, there are other compensating factors. First is supply chain disruptions still continue as we go along. Second is, telecom prices have been pushed up. And chances are that industry will see more re-rating as we go along. So That is pushing up inflation already by 30-40 basis points. Likewise, power prices probably need to go up. They haven't been adjusted for the changes which have happened over the last few months. So there is incipient both core as well as non-core elements of inflation. And so we have a very toxic policy mix of an uneven growth with the risk of pretty high inflation. Just one quick point on inflation. Globally as well, developed markets are clearly focused on inflation, particularly the US. And they're very, very worried that inflation expectations and inflation are getting slightly out of hand. In fact, the Federal Reserve has indicated that it's ready to accelerate the taper. Correct. And probably go into a rate hike mode next year. Markets are in fact factoring in 3 rate hikes by 2022. So developed markets as well as India will be focused on inflation, and it is a definite risk. For us, it looks like, I hate to use the word, but a bit like stagflation, uneven growth and inflation.
Right. So taking all of this into consideration, another aspect that we want to talk about is another fiscal deficit, because if you see the April to October period, around 36.3% of the budget estimate is what we saw, as against 119.7% of the budget estimate of the previous year. Now, government spending has been under pressure in the month of October as well. What is your view? Do you think there is a possibility of a pickup that could happen from here on? That's one. And in turn, if that happens, how are you viewing fiscal deficit?
Great question, Hiral. So look, the good news first. I mentioned to you that our digital payments have gone up dramatically and that our GST collections are looking up dramatically. That is reflecting in tax collections as well. To your point on the data up till October, the budget numbers show that tax collections are running far ahead of budget expectations. In fact, for the full year, tax collections might probably exceed budget numbers by over 2 lakh crores at the central level. So that's excellent news. I think the whole point about formalization of the economy leading to better tax to GDP is playing out finally, and it's a good trend. Hopefully, this will continue for a long time. So that's the good news. The indifferent news, or the bad news, really is on multiple fronts. First is the government has announced a few additional items of expenditure, as you know. So because of the second wave, it had given out increased food subsidies. It had given out more relief to the farm and to the employment sectors. Narega outlay has been increased now. There's an additional grant which has been given, 20,000 crores. So more expenditures have been incurred. They're not all been booked as yet. But as the finance secretary was telling us the other day, they will be booked by March. So expenditures will be higher than budgeted. Okay, that's the first part. Second part is, remember, there's a shortfall in GST compared to what the states were expecting under that 15% formula. For this fiscal year, that's about 1.58 lakh crores, which the center is giving to the states against future receivables on the compensation cess. That is not being accounted for as an expense anywhere, either in the center nor in the states. It's like money from thin air, which will be collected against future cess collections. If I add that as well, actually as an expense for one of the center of the states, it does show another additional hole in the overall math. Third issue is states. And this is where the soft spot is really. State collections on taxes have really been low. What the center has been paying to the states also has come down. Remember, the center has collected a lot of additional taxes through oil, etc., much of which comes in the form of surcharges and cess, which are not shared with the states. So in fact, the payment to the states have actually come down, at least at the devolution level. So state deficits are looking pretty troubled, and many of them are probably pushing it downstream into power companies, the discoms, the state transport utilities, and they are hiding the deficit somewhere. So there are holes there which need to be taken into account. Finally, here a last point. There are entities, while the fiscal deficit in entities like Food Corporation of India has been cleaned up. I think the center has done a fantastic job of cleaning up that math. There are still question marks about entities like NHAI, about REC, PFC, which are not fully resolved as yet. So all these bad news put together, unfortunately, more than compensate for the good news of higher tax collections. So while many analysts say that fiscal deficits are looking good, I'm not so sure. Yes, tax collections as a percentage of GDP are looking fantastic. That's a great sign. But unfortunately, our pressures on expenditure, especially at a state level and at a PSU level, still remain very, very high. So overall, not a great picture.
Right. So with all of this said and done, the RBI overall has done a fantastic job in the last 12 to 18 months of how they've actually been proactive at taking measures. With the next MPC meeting as well, what's your view? Do you think, we've spoken about though the GDP has touched pre-pandemic levels, but the recovery still remains uneven. So do you think the RBI's view will likely warrant extended support?
Great question, Hiral. I wish I knew the answer to that. I would have become a rich man by now. But let me tell you my guess. It's a very, very tough policy context for the MPC and the RBI. Uneven growth, high inflation, fiscal pressures, need for support for the larger informal economy. Very difficult to reconcile all of this. We haven't talked about foreign exchange markets. They play a role as well. Okay, so there is a mix and match that they have to try and balance out. I think given that Omicron is still an unknown, while we have hopes about Omicron, we still don't know. At this point in time, they might choose to be cautious. And to be honest, they've already done a bit of tightening. Okay, so for instance, they have reduced the amount of overnight liquidity surpluses over time. They have stopped buying bonds in the secondary market. Since November, they have not been doing open market operations of bond purchases. They've not been doing GSAP purchases. So effectively, they've stopped a lot of the relief to the market. At the same time, they're being cautious and they're being very, very, soft about normalization. I think normalization might take a bit of a backseat for now until Omicron becomes, the clarity around Omicron comes out a little more. But going forward into the next year, I think it's inevitable that yields will have to go up. Your 10-year bond is about 6.4% today, 6.39% today. It might have to go up to 7%. I think RBI will allow that over a period of time. Difficult to see that not playing out given inflation fears, etc. At the same time, they will try and keep the short-term rates under control. I don't think they will go for rapid rate hikes. The market, by the way, is pricing in something like 100 basis points of rate hikes during 2022. Okay. I don't think that's what the RBI is penciling in. They'll probably have 50 basis points of rate hikes second half of next year. So slower on the rate hikes, trying to ease the pain on the short end, allowing the longer end yields to go up, and maybe savings rates for you and me to go up therefore on the longer end. I think that's the policy mix that they will try and take. The one sign they look for is credit offtake. So credit offtake right now is just at about 6.5% for 2 years period. Okay, it's 7% for year on year, but 2 years 6.5%. So if that goes up to 10, 12%, that's when I think short-term rates will start to go up. Otherwise, for now, they will probably give growth a chance by keeping short-term rates under control, but longer end rates could go up a little more.
Right. So overall, how do you see the rupee and the bond deals moving from here on?
So as I mentioned, Hiral, again, I could be completely wrong. So if I'm wrong, this conversation never happened. Yeah. But I do think the 10-year bond yields over the course of the next year could go towards 7%. By the way, I think RBI might consider giving directed liquidity towards sectors like ESG and infrastructure, especially as the longer end yields go up. So they might announce TLTROs for ESG compliant projects, etc., as a way of ensuring money goes into the right investments. But otherwise, overall yield should go up in the longer end. Shorter end, I don't think will go up as much as the market expects. So that's the broad expectation of interest rates. On currency, again, because our top 20% is doing well, consumption has gone up as well. The top 20% of our population accounts for most of the discretionary consumption. So look at our imports of gold, of electronics, of chemicals, of fertilizers, of plastics, of toys. They're all going up in the last 3 months. Since September, they've been going up, September, October, and November. And that trend continues. Our current trade deficit is in the $23 billion range for the last 3 months. With that continuing, I think our current account deficit will go up. It could head towards 3% of GDP, which is a very large number. Anything about 2.5% is a bit of a worry. RBI has plenty of currency reserves right now. $640 billion is not small. They can easily control, any outflows, etc. But I do think that higher current account deficits will put pressure on the rupee. RBI will slow the process of depreciation, but not entirely stop it. So I think by the end of next year, we could be looking at dollar rupee at closer to 78 rather than the 75 it is at right now. So slow, gentle weakening of the rupee by about 3 rupees or so. Bond yields 10 years going to about 7%. Short-term bond yields remaining under control because of RBI not hiking rates as much as the market expects.
Right. All right, Ananth. Thank you so much for getting us your views. Looking forward to our next discussion as well from here on. Thank you. Stay safe.
Thank you too. Thanks a lot for this conversation. Take care.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.